Welcome to the second video where we look at management accounting. Here we examine product costing from the perspective of Chain and Gear as a retailer, but also from the perspective of the manufacturer of the 2i bike helmets, the core product that the company sells. In doing so, we're going to focus on budgeting over the next 12 months for Chain and Gear and looking at the key product cost and what we call period cost for that period. In previous videos, we've looked at the actual financial accounts records for results for the first quarter and also looked at predicting the remaining 2 quarters for that period. Here we look at budgeting over the following financial year. To do so, we're going to look at cost categories again. As you may recall, we looked at financial accounting cost categories, but this video is much more about the labour, materials, expenses for Chain and Gear, the fixed and variable costs, and also the direct and indirect cost. So we're going to take a much more management accounting focus on these 2 key areas, particularly direct, indirect, fixed and variable costs. Chain and Gear as a retailer has a very different perspective from our French manufacturer, and we're going to examine each in turn to see how we can review costs and also pricing. At the moment, if we look at the right-hand table, Chain and Gear as a retailer is paying £30 for the 2i bike helmet from the French manufacturer. This is what we call a direct cost or direct material costs. Presently, there aren't any direct expenses or direct labour costs. We simply sell on the 2i bike helmet. Certainly, from your student perspective, you may consider in your business plan when you sell new products that you may have direct labour and direct expenses that could be added to your product cost. But just for now, we have in the 2i bike helmet, we simply have the material cost of £30. There are no indirect costs to get the product to the customer, and our cost of sale is therefore £30. As we sell the product for £50, our gross margin is £20. This product costing isn't straightforward, however, for the manufacturer. Yes, the manufacturer could certainly identify the direct cost of materials and labour and expenses, but indirect costs are a little bit more difficult. And the question is, how do we actually get things like heat, light and power of a factory and allocate those costs to an individual product? How do we take depreciation for the machines that make a range of products directly to an individual product? So we need to examine how that process would work. We're going to use a technique called absorption costing to do just that. In our factory, we are mainly machine intensive as opposed to labour intensive, and the factory estimates that to work for £50,000 over the next planning period to produce all of the products, and the indirect costs in total will be £500,000. If we divide the machine hours into the indirect costs, we come up with what we call an absorption rate of £10 per machine hour. And this is very useful. So depending on how long a product spends in the factory environment and working with our machines will determine how much of a cost is associated or like a magnet attached to that product as it works its way through the factory. The 2i bike helmet happens to take half an hour or 0.5 of an hour. So the charge, indirect cost, we're going to put to this product is 0.5 times £10, which is £5 per unit. This is a very useful piece of information. We can now look at the direct costs for the 2i bike helmet, which in our right hand table we can see are £19. So our materials, labour and expenses direct £19. and the indirect costs are £5. Therefore, the manufacturing cost is the sum of those two, which establishes is £24. Obviously, the manufacturer wants to make a margin, and if we add that, we end up with a price of £30 per unit, which we would charge to Chain and Gear. Alternatively, we could look at what we call marginal costing. Marginal costing is particularly useful if we look at short-term decision making from both the manufacturer perspective and from the retail perspective in Chain and Gear. For the manufacturer, over what we call the relevant range, let's say for example over the next 12 months planning period, there will be fixed costs and variable costs of production, and it is assumed that those fixed costs will not change over those next 12 months. Therefore, we need to look at the effect of future decision making or plans on changes to our costs. So we're looking at what we call our opportunity costs or our relevant costs. So, for example, if Chain and Gear were to approach the French manufacturer for a short-term order, and the company manufacturer had spare capacity, it may consider that it only needs to look at its variable costs, because in the short term the fixed costs will remain unchanged. So were Chain and Gear to ask for, say, a short-term order of 1,000 units, the French manufacturer may consider that as long as it covers the short-term cost of £19 for manufacturing the 2i bike helmet, if the product is sold for £20, it would still make a contribution of £1 towards those fixed costs. Now, this is a very useful piece of information for obviously for Chain and Gear, but also for the French manufacturer. There's almost a minimum price to be charged to the customer. Therefore, if we look at the first draft plan for Chain and Gear in our column here, we have all the various numbers that have been collated, and much of this has been worked out based on a product cost per unit of £30 for the 2i bike helmet. This is what we call our product cost area, and you'll notice this is in contrast to our period costs in the bottom part of our income statement. Therefore, Chain and Gear could consider that actually there is some negotiation to be had with the supply of the manufacturing of the 2i bike helmet, and the scope for the cost of sale to be reduced depending on the size of the orders that are made. So here we have the first draft for the plan, but certainly we could consider that we could have a lowering of our cost of sales as a result of looking at marginal costing from both our perspective and from the French manufacturing company. Therefore, we can see the importance of these costs to future planning for both Chain and Gear and for our manufacturing company. So in terms of product costing of our product or service, we should examine both direct and indirect costs, and also fixed and variable costs. We could look at full costing of our product, and absorption costing is a technique we could use. A further technique we could use is activity-based costing. Alternatively, we could look at marginal costing, where we're looking at the contribution towards fixed costs.